All right, so here is a Starbucks convertible bond. So Starbucks early in their life stage issued a 6% bond. That's the interest they're paying. Starbucks gets away with paying less on the bond than they would if it didn't have the conversion feature. It has 10 years to maturity. So in 10 years, Starbucks, the issuer, is going to say, Brenda, what would you like? Would you like your $1,000 back that you lent us with the bond money? Or do you want X number of shares of Starbucks? When these bonds were issued, Starbucks was 38. It makes no sense, Brenda, to turn it into stock at 40. Very important. In terms of the economics of a convertible, it's more important that we know the conversion ratio than we know the conversion price. In an earlier session, we talked about this concept of dilution. And if everybody asks for this stock, there's going to be more shares of Starbucks outstanding. Howard Schultz only owns about 5% of Starbucks. He used to own 100. It's not because he sold the Starbucks stock. It's because over the years, he kept issuing more stock to expand the business. And when they told him, they said, hey, you're borrowing all kinds of money. He said, well, I'm not going to have to pay it back. And they said, well, what do you mean you're going to have to pay it back? He says, all of Starbucks debt is convertible. I'm going to make damn sure they say, give me the stock.
Mm.
And they said, well, if they do, you're going to be diluted. He goes, so what? I'm going to own a smaller portion of a bigger pie. Instead of owning 100% of 8 stores, he owns 5% of, 7,000 stores, right? So first thing is we've got to know the conversion ratio, and that's based on par. So to establish the conversion ratio, we're going to take par, we're going to divide by 40, and we come up with 25 shares. So that's important because remember, 10 years from today, Starbucks is going to say, Brenda, do you want 25 shares of Starbucks or do you want your $1,000 back? Now we know what you're going to do. You're going to take 25 shares times the current market price. And if that's more than 1,000, you're going to say, I'm going to take the stock. And if 25 shares times the current market price is less than that, you say, you know what? I want my money back. Right. So it's based on the economics of converting. As I said, I wouldn't worry about the conversion price, but we could do this either way. We could find out the conversion price is 40. As I said, the ratio is much more important. Now, after Starbucks issued these bonds, Starbucks went to 50. They took the proceeds, they built the business, and it's driven by the market price of the stock. I say, Brenda, right now we could turn this into 25 shares of the $50 stock. We don't have to, but it's also driven by the interest rates. Hello? 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 That was a number from where my dad lives, and he's getting up there, so I want to make sure there's no
Oh yeah, you
usually I
bet.
don't answer question. So parity just means equal value, right? There's a lot of parity in the NFL or the NBA. That just means equal. So parity is when the value of the bond and the shares are equal. And to calculate parity, which we're going to do, we need to know the conversion ratio. That's why I said that is so, so important. So here, parity of the bond. So when does the bond's price equal the stock equivalent? So we'll do both of them. We're either going to multiply or divide. So as we said, Starbucks here had a conversion price of 40. We said it's 25 shares, and now the stock is trading at 50. I say, Brenda, if we turn this into the stock at 50 and we got 25 shares, that bond is worth 1250. You said, well, we only paid 1,000. I go, yeah, aren't we looking good? We're looking pretty damn good. And the reason we're looking good, Brenda, is because the stock was 38 when we bought the bond at issuance, and now it's 50. Now, in the real world, I say, Brenda, do we want to cash out? You said, what do you mean? I said, do you want to let it ride or do you want to sell your bond to someone else? You go, well, Dean, if we sell it, what would be the current market price? They said, well, Brenda, somebody be willing to give us a little more than parity. We wouldn't sell this bond for anything less than 1250. In fact, we'd say, listen, Brenda's bond is convertible into 25 shares of a $50 stock. And they say, what'd Brenda pay for it? I say, none of your damn business.
Mhm.
That's not what we're here to discuss. We're here to discuss what you might be willing to pay. So now we're going to go to the other direction. So we're considering buying this in the secondary market, and we would have the expectation that we would have to pay a premium for the bond. So let's say the current market price of the bond is $1,300. And now it's convertible into 25 shares of the common. So I say, Brenda, if we sell the bond to someone for $1,300, they must have the expectation that Starbucks is going to 52 because that's what parity is. Paying $1,300 for this bond is the equivalent of paying 52 for the stock. Right now, the stock is 50. So right now, that makes no sense. But hey, every day is a new day. Starbucks could be 60, could be 70, whatever it happens to be. So convertibles are part of the capitalization of a company. And what are the advantages to the issuer? It makes their debt easier to sell, more marketable if the bond is convertible. So as a banker, I say, why don't we issue some convertible bonds? It lowers the interest rate that you would otherwise pay from the issuer. What's the advantages to an investor? I say, Brenda, you get the safety of debt, your creditor, Starbucks, but you get the upside of the stock. Pretty cool. Pretty cool. We talked about this concept earlier. The existing shareholders, Brenda, had to vote in the favor of the issuance of these bonds. Why? Because the existing owners of the business from an earlier session have a preemptive right. They have the right to maintain their proportionate ownership. And these bonds represent potential dilution. So it makes sense that the bond of the Starbucks common stockholders have to say, yeah, let's do this. Because when these people convert, which they did, Howard Schultz and everybody else's proportionate ownership is going down. There's going to be more shares outstanding. Also, in the trust indenture is the contract between the issuer and the trustee for the benefit of the bondholder. I'm going to say I want to be able to convert into the same proportionate ownership. So if Starbucks splits their stock or they pay a stock dividend, I would want my convertible to be adjusted accordingly. So if Starbucks pays a 10% stock dividend, I want 10% more shares. So instead of 25 shares, I want another 2.5. I want 27.5 shares if I convert. So it has to be adjusted for this concept we discussed earlier of dilution, right? I think the most important thing about that discussion is understanding the concept of the conversion ratio. How many new shares are going to be issued if those bondholders convert, right? So that's the main thing. All right, that was the last cleanup item for you. I got a deal for you. Either you can settle up with me, you owe me for tutoring, or you can give me permission after you pass to use this on my channel. And if that's the case, I'll just call it even on what you owe me.
What?
Yep, it's up to you.
God, that would be awesome.
Okay, so we're even, Steven.
I do have
And,
a couple more questions, though, if you don't mind. Just a
okay.
couple. Okay,
All right.
so is there a calculation on warrants?
I doubt you're going to see it.
Okay.
But what you should be able to do is contrast rights with warrants. Rights versus warrants. So remember, we talked about your right to maintain proportionate ownership.
Yeah.
And that means you have the first right of refusal on the issuance of new shares. So we have to first come to our existing stockholders. The way we do that is with what's called a rights offering. I say, hey, Brenda, you have 1,000 shares of that company, and that company is going to be issuing new stock. I'll just give you a real world example. We do an IPO. We buy 1,000 shares at 10 of this microbrewery. They're raising $10 million to become a macro brewery. And we buy 1,000 shares at 10. And I call you and I say, hey, Brenda, you know that microbrewery stock we bought? You say, Dean, you got a lot of guts to call me. It's at 5. I go, I know it's embarrassing. I'm with you. A bottle of your beer is actually worth more than a share of their stock. I get it. Listen, I think Brenda could still have a happy ending. Now, if they can get this brewery online, I think it's going to have a happy ending. But to do so, they need some more financing. The most likely candidates to provide the additional financing, Brenda, are the existing owners like you that are already in the hot water. And before they go to raise that money elsewhere, They have to ask the existing owners like yourself, would you like some? Now, if they can be successful in getting the money from the existing shareholders, they'll save money on investment banking fees. So they're going to let you subscribe, and this is the test point, at less than the current market price. So at issuance, the rights are exercisable below the current market price. That's a good deal. Gives you an incentive to invest, right? Rights are short term. It makes sense they're short term because they need the money and they need it like now. Now, we can't make you buy the new shares. But if you want to buy the new shares, the stock, as I told you, is at 5. They're going to let you buy it at 4. Pretty good deal. It takes 2 rights to buy an additional share. I just made that up. You only have a right to maintain your proportionate ownership, so you don't get to buy as much as you'd like. It's the proportion. So in my example, if you want to participate, we'll send your 1,000 rights, 500. How do I get 500,000 divided by 2? 500 shares times 4. We'll send $2,000 with the rights to the transfer agent. You will have maintained your proportionate ownership. You say, what happens if I don't? I said, well, Brenda, if you don't subscribe, any shareholders don't subscribe, they're going to raise the money elsewhere. They're going to sell the stock elsewhere. They have an investment banker, perhaps, depends on the deal, standing by. Now, standby underwriting is used in a rights offering to make sure the shares get distributed. So Goldman Sachs is standing by.
So a reason they wouldn't exercise the rights at a lower price would be maybe they don't have the money, or
Yeah,
why?
that or you're pissed off. You say, Dean, I'm not throwing more money into the. Yeah, when we ask
Gotcha.
people that, I was involved in an investment, and I said, hey, Brenda, I get it, man, you're upset, but some people are going to come up with the capital call. Some people are not. You
Gotcha.
know, the people who don't, they own a smaller portion. But you may be, your point, you may not have the money. It takes money to participate, right?
Right.
Okay, now, different deal. I call you up and I say, hey, Brenda, are you familiar with a unit? You go, no, what's a unit? I say, a unit, Brenda, is more than one security offered together. So I have 2 securities I want to share with you. First, Brenda, I want you to lend this biotech company $100,000. I want you to buy 100 of their bonds. They pay 8%. So if you buy the bonds, what I'm recommending, you get $4,000 on January 1st, $4,000 on July 1st, assuming they don't default. I mean, and these bonds are not rated. We think this biotech company could become the next Amgen or Chiron or Genentech. Right now, it's an acorn. We think it could become an oak tree, but not every acorn becomes an oak tree. Some acorns just end up as squirrel food. And you go, Dean, that's all you got for me? Brenda, I agree that if all I had for you was a bond that paid 8% that may default, you might pass. Are you ready? I have a sweetener. Brenda, sweeteners get people to eat things they might not otherwise eat.
I'm going to eat it anyway.
So here's the sweetener. Each of these bonds have warrants. Warrants, test question, are long-term. So you got to be able to contrast the rights with the warrants. So over the next 10 years, up to the year 2035, you can buy the stock at 6. And he said, well, Dean, right now that makes no sense because it's 5. I said, well, you're right. Right now that makes no sense. Hey, well, the next 10 years, who knows? Maybe they get bought out or some crazy thing. Warrants are long-term and exercisable at issuance above the current market price.
So it's stated in the offering, you're right now it's selling for 20, and if you be able to sell the warrant when it reaches 40.
Good question. So on rights and warrants, there's 3 things that you can do with them. I think a good memory aid device is T. You can trade them to someone else. That's the T, right? I say, well, listen, if you don't want to subscribe at 4, they have a theoretical value. Being able to buy the stock at 4 when it's at 5 theoretically is worth $1. Something in the real world is only worth what someone else is willing to pay. But it takes 2, so theoretically these rights are worth 50 cents. And so if you don't want to exercise, let's trade them. You can exercise your rights or warrants, or you can let them expire. A good example of this was a PIPE, a private investment in a public entity. And this was a private investment where they're buying unregistered securities in Bank of America. Berkshire Hathaway said to Bank of America, how about you issue 50 million shares of a 6% preferred stock to Berkshire Hathaway? Those are unregistered shares. There is no public marketplace for those preferred shares. And then Berkshire Hathaway said to Bank of America, we would like a sweetener. 50 million shares at $100. I'm going to provide you with $5 billion in equity financing, Bank of America. And when people read, this is 2010, that Berkshire Hathaway is dropping $5 billion in equity capital into Bank of America, that will serve as the good housekeeping seal of approval. Yeah. And so here's what we want as a sweetener. We want the right to buy 700 million shares of Bank of America for 10 years out to the year 2020 at $7 a share. When this transaction was done, Bank of America was 6. So right now it makes no sense. In 2015, Mr. Buffett exercised and Bank of America was $30. He bought 700 million shares at 7. That provided Bank of America, by the way, with another $4.9 billion in equity financing, bringing Mr. Buffett's investment to a total of $10 billion in Bank of America. That was a warrant, that was a sweetener, and it was long-term and exercisable above the current market price. Please note, your concept in our earlier session, that represented and did create dilution to the Bank of America common stockholders because they just issued 700 million new shares to Berkshire Hathaway. So everybody else's proportion ownership went where?
Yeah.
Down. But hey, you say I got a smaller portion, but I got Mr. Buffett on board, hey?
Yeah, yeah.
Is what it
Any
is.
part of it, any part of that pie is good.
Yeah, I think so. I think so. All right, what else is on your list?
Let me see. There was one more thing. I don't think it'll be on there, but it did come up when I was Googling 82, modern portfolio theory.
Okay, so theory isn't truth. It's just a way of explaining things. The more a theory can explain, the better that theory is. And there are men and women who go get PhDs in modern portfolio theory. The biggest concept of modern portfolio theory is the concept of negative correlation provides additional diversification. So if I'm a portfolio manager and I have Exxon in your portfolio, and I put in there, Brenda, Chevron, under modern portfolio theory, I haven't accomplished anything because those have positive correlation. They go the same way. So I put Delta in your portfolio. And now I call you and I say, hey, Brenda, yeah, we're getting killed on the price of oil. That's bad for Exxon. But good news, good for Delta.
Yeah.
Delta flies planes around, so lower jet fuel is good. Oh, Brenda, hey, oil's going up. Bad for Delta, good for Exxon. So the idea is we, under modern portfolio theory, want to have things that have different correlation, negative correlation, because that would provide additional diversification.
Awesome. Well,
okay.
10 o'clock in the morning.
I'll be with you in spirit. So
send me good.
Don't call me from the exam. I got to believe one time. Where you? She goes, I'm at the exam. I go, oh my God, hang up now. Most important thing for you, Brenda, you worked hard. You were dedicated. You were disciplined. You were organized. The most important thing is be confident in the execution of your study plan. Be confident in yourself. And the most important thing, be confident in your answers tomorrow. If you're going down, man, go down with confidence. That's my answer. I'm sticking to it. Yeah, don't be going, what have they meant? They don't. Don't be bringing extra questions into questions. Aim and shoot, point and click, matriculate down the field into scoring position.
Yeah, yeah.
All right.
I'm thinking right now of all the people on the Titanic. I hope they went down with confidence.
Yeah, there you go. May as well.
All right, sweetheart. Thank you so
well,
much.
If anything happens, you need a little rah-rah, whatever, you know how to reach me.
You're the greatest.
Okay. All right, Brenda. Bye-bye.
Bye.